Does standing by your marketing strategy often feel like walking the plank? Is guesswork unbalancing your marketing decisions?
Ni hao ma. Happy Friday, everybody. Welcome to Forex.Today, the YouTube community of almost 19,000 foreign exchange traders. Thank you for being here. The last day of the week, last day of the month for trading. Without further ado, let's go. Let me remind you that trading is risky. It's not appropriate for everyone. However, your past performance, good or bad, is not necessarily indicative of future results. Therefore, please play small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Hi, my name is Wayne. I'm a currency trader just like you, and I've been sitting at my desk trading Forex since 2004 as a professional full-time trader, but even longer than that as someone trying to figure this thing out. And so thank you for joining me on my journey. And I am here to share my experience, the good, the bad, and the ugly, on how to trade Forex. Technical analysis, fair game. Fundamental analysis, fair game. Trader psychology, fair game. Macroeconomics, fair game. Central banking policy, fair game. Just ask questions, get involved. Be a part of this community. I'd like to thank you for your positive energy and your contributions that you make every single day. Thank you very much. Right? It's weird how we get to Forex. I was reading Architectural Digest magazine and I said, you know what? I want to become a Forex trader. Johnny's underneath the North Pole thinking, you know what? This is cool, but I'd rather be trading Forex. And boom! Just like that, right, Johnny? It's amazing how we get here. But now we're at this intersection. You bring all your good, bad, and ugly. I bring all my good, bad, and ugly. And together we are better. We are better together. So thank you for being here. I'd like to thank Traders Way for being part of our community as well. Ultimately, when you have the confidence to trade real money, you're going to need a broker that you trust because of the aspect of custody, primarily. But then on top of that, there's the aspect of how fast your execution is. Okay? Latency. Some brokers are slow, some are fast. I had a report, I don't know how many years ago now, and I can't remember where I got it, but I got a third party, trust me on this one. I had third party analysis of the latency, aka the speed in which trades are executed into the interbanking system. And Traders Way wasn't the absolute fastest, but it was very, very, very fast. And much, much, much faster than the big brokers you're probably most familiar with. And I'm like, wow, that's cool. But then I also look at things like swaps. And the swaps that Traders Way pays are huge, especially relative to some brokers, which charge you negative swaps no matter which way you're trading. So I'm like, wow, that's another plus. World-class customer service, above average, good-looking people. Traders Way's got it all, but mostly they've learned my loyalty and respect. Perhaps if you visit tradersway.com and open up a demo account and trade on MT4 or MT5 for a few months, perhaps they'll earn your loyalty and respect as well. Tradersway.com. Okay, so Morena's here. Whoop, whoop. South Africa winning gold at the Olympics for swimming. That's cool. Right on. Congratulations. That's really good. Okay. Where are we? Well, I had an idea earlier today, and I guess maybe let's start with that idea. New window to the world. And where did it go? It didn't open. Okay. You are the one. All right. All right. I thought what we could do is review the week. Just quickly here. Okay, let's take a look at some of these big events. Whoop, whoop, whoop. Hang on. I'm trying to get this to fit at this resolution. All right, cool. Durable goods came out about expected. Okay, that's the sort of core durable goods. Okay, headline is a little bit less. What does that tell you? A lot of defense spending. And airplanes, right? RBA speech, okay, obviously that was important. Here we go. Australian inflation, slightly hotter than expected. Okay, still quite low relatively, right? You can see CPI is only less than 1%, but just notice that we go for something like 6, 7, and now 8%. So there's some upward pressure here. Okay. Year over year, we're looking at 3.8%. Why is that important? Well, you want to look at real yields, correct? So you're going to have to look at, I don't know, you could take something like a 10-year Australian Treasury, subtract inflation, and what is the real yield? 10-year Australian government bond rate. We'll take that one. Okay, so what? Okay, yield is low, inflation is high, negative real yield. In the United States, I think the negative real yield in the U.S. is 1.2? So that's quite negative, okay? That's quite negative. They have a lot of inflation for a very low savings rate, if you want to consider it that. Okay, I know it's not a savings rate, but it's the decision. Okay, all right. Coolio, Consumer Price Index out of Canada. Okay, year over year, 2.7. What? Australia, 3.8. Canada, 2.7. Australia, 3.8. Canada, 2.7. Australia, 3.8. Canada, 2.7. %. Okay? Less negative of a real yield. Okay? 1.2 versus 2.7. This one is 1.2 minus 3.8. So less of a negative real yield. Okay? How do you say that? Well, interest rates are higher in Canada than they are Australia. Wait. You mean less of negative? Yes, less negative is similar to more positive. No, it's not more positive, but it is less negative, which might make this a little more bullish than Aussie. I don't know. Analyze it. Okay. You might say here, okay, you might use this number and say 3.1 is probably more accurate than 2.7. Okay. And closer to Australia, which is 3.8. Okay. Interest rate decision. Okay. Now, I want to make this clear. That's the Fed funds rate. You can't get that rate, right? But a bank lending money to another bank gets that rate. A high quality, low risk client to a bank pays the prime rate, but they don't pay the Fed funds rate. And so the prime rate is going to be higher than this. So the way it goes is, when I say interest rates, you could have the Fed funds, okay, and then you have the discount rate. What's the discount rate? Does anyone want to guess? Take a shot at that discount rate. What is the discount rate? While you type that into the chat, okay, then I'll put up there's a prime rate. Okay, and then you could carry all this way through to like a mortgage rate. So what's the Fed funds rate is a bank to bank loan. Nobody's going to take a shot? All right, maybe there's a lag, so I'll just write it down. This is a Fed to bank loan. Okay, and this is a bank to best customer. Loan. Okay, which means that's the lowest loan rate you can get. Okay, LIBOR says rate bank gives other banks. Wrong. Discount rate. Central bank to bank loan rate. Brandon got it. Congratulations. Cool. All right, so we'll just move on. Just a little bit of monetary policy for you. Boom. All right, going into Germany. Okay, unemployment rate 5.7. Cool. Okay. Okay. Less negative is positive. Okay. Unemployment. So they say it backwards, right? So it's not the rate of employment, it's the rate of unemployment, and a negative number is a good number. 91,000 people no longer don't have a job. I always find it backwards thinking. It's that double negative thing. Another way of saying it is 91,000 people got a job, but that would be employment change. Strange, right? Hey, maybe this is the basis of European problems. They think backwards. Hey, whoa. Don't flame me. All right, don't flame me. I take it back. I'm so sorry. All right. Great. Inflation, year over year, 3.1. Canada, 3.1. Australia, 3.8. You starting to make connections here? All right, great. US GDP, 6.5. Yeah, whatever. Okay, great. Okay, let's go back to Germany. GDP, what? Okay, so here's what happened. It was negative 3.4. Now it's plus 9.6. What do you think the reality is to go from a negative to a positive? You know, one fun thing you could do is 9.6 minus 3.4. I know that's not true, but think of it. What is it really? 5 something, right? Okay, whatever. European unemployment rate, 7.7%. Okay. Hey, pretty good for a socialist. Boy, I'm on it today. I'm hot today, crushing the European jokes. But anyways, look, let me just say it this way. There are different forms of capitalism. Okay? You could have like socialism, which is guaranteed failure. And then you have capitalism. But, right? And then there's something somewhere in the middle. Okay, here's your wrecking ball. Okay, that's your wrecking ball. Now, if you swing too far here, it creates problems. If you swing too far this way, it creates other problems. Okay? It's sort of like if you swing this way, everyone gets poor. If you swing too far this way, 1% of people own everything. So nobody wants either of those situations, right? So like here, 100% people end up being poor, except the government leaders that rape and pillage everything. Is anybody familiar with that model? Or 100% of everyone is poor, except the government, which rapes and pillages the poor. Some of you might be familiar with this model. Okay? This other model is 99% of everybody is poor. Okay? Except for the government that works for the 1%. Okay? Maida's familiar. Yeah? Hey, good to see you, by the way. I think you've been on vacay. Yeah, Cuba? Anybody else? By the way, actually, Maida, speaking about this, 100% of poor except everybody, except the government, I'm not even familiar with like the Cuban politicians. Like, are they ballers driving around in Rolls Royces and stuff? I don't think they are, right? Even right? Are they? I mean, obviously, if you live in the palace, you're right. You're doing pretty good, but there's still this aspect of your granddaddy used to live in the jungle as a gorilla, right? Like, isn't that still around? Or is now the grandchild in charge and he is just rolling around in, yeah, oh, they do, Rolls Roycing. All right. So anyway, so obviously that sucks and it's stupid, right? North Korea, that's not even a country. I mean, it's a country, but they don't even have an economy. Okay? I wouldn't even call North Korea socialism. That would be dictatorship. That's not even a social structure. So, I'll take it that far, right? Like, right? The only reason it hasn't been failed is China will support it. Now, oh, wait. I don't want to get into this. So now I'm about to give you a lecture on the Korean War in the 1950s. Whoa. Let's just move on. So anyways, Europe has decided to put the wrecking ball here. And the United States has decided to put the wrecking ball here. But in the U.S., it's going this way. And I don't know what's going on here. Sort of here. I don't know, but not really. Probably just going nowhere. Okay? And so we're making choices. Okay, now when you make the choice, check this out. You'll have 7% unemployment here, and you'll have 4% unemployment here. Now, we have high unemployment because we've chosen a system which is closer to the European model, where it's like, oh, you don't have a job? Don't worry about it. We'll give you money. And, oh, you can't pay your rent? Don't worry about it. We'll pay your rent too. Okay? So we're more like 5.5%, 6%, but that's going to change, and we're going to move closer to 4% to 5%. And so that's going to change pretty quickly in September. And so we're going to move that way. Okay? So this is just a social choice. So I'm not here to say one is good or one is bad. All I care is you're capitalist. Okay? Because there's consequences to both. One, this is more stable to have 7% unemployment all the time. If you're in Spain, it's 10% unemployment all the time. But that's stable, isn't it? You don't have booms and busts. Okay. So that's just, okay, that it is just what it is. It's always going to be higher than the United States and Canada. Canada is always going to be slightly more than the US, probably. Although it's a smaller, like, it's easier to analyze, 400 million people in the EU to, 350 million people in the US. That's easier to compare. Canada being 30 million, it's hard to compare because it's not going to be quite the same. All right. So, and what? And I guess we got all this today, right? So I like to pay attention to the Chinese data. Okay. That kind of stuff. Okay. How come we don't have this on the calendar? Hang on. There we go. All right. Gotta go do that again. Oh, I don't have that printed. Interesting. Anyways, so you want to kind of look at PCE year over year. Okay. So what do we know? You can say, oh, well, I've been tracking the growth rate or inflation rate, whatever you want to call it. They're similar, right? Just different measurements of different things, but you can't have inflation. Oh, I should probably talk about that a little bit later. But you can't have inflation with no growth. All right. Now some people are going to freak out right then and there. But let me just finish my thought process. You could compare the United States, this 3.4 number, okay, to Canada, 3.1 or 3.2, right? To Europe, 3.1, 3.2. Australia, 3.8. You're like, whoa, 3.8 is hotter than all these other numbers. By the way, do we have a PCE number? Luis says socialism sucks. In my opinion, that is true. Okay. July. Yeah. All right. So 4.0. Okay. That's coming in hot, right? Cool. 4.0. So we're higher than Australia. Australia is higher than Canada and Europe and Germany specifically. Okay. How many people here having, I don't know, accidentally bumped into the media? Okay. How many people have run into the discussion of stagflation? How many people have run into this recently? That we're going to run into this. That high prices are going to kill growth and create stagflation. Anybody? If nobody has run into this, then I'll just move on. I just thought, you know what? Because I did hear it, and I'm like, they don't get it. Yeah, in the news 5 to 8 years ago. No, I'm talking about in the last 10 days, let's say. Okay, if the answer is no, then we can kill it. Steve says yes. Oliver said yes. Look, like seriously, if it's not hitting you, then I'll just move on. I'll just answer it like this. It's not going to happen. Okay? It logically makes sense if you don't understand the full context of the situation. Yeah, Nuno defines it. Okay, you do want it. Okay, you guys have run into it. Okay, so that's what they're saying. Because of the high inflation rate, which is a supply issue, not an economic issue, which means supply and demand will find equilibrium if the government just leaves it alone. You have to understand that. Prices are high because there's no supply. So what do? You wait until supply is fulfilled, price moves back to equilibrium, because when supply is low, price is high. Then when supply comes back to equilibrium, price comes back down to equilibrium. And then so this year, let's say, I'll use lumber as an example. You decide to build a deck in your backyard. So you Google Home Depot and there's no lumber. You're like, holy crap, seriously? So you call your contractor and say, hey, can you buy the wood? Because I can't get it at Home Depot. And he's like, no problem. I'll call my contractor supplier. So he calls and he's like, okay, great, but prices are up 100%. And you're like, what? And he's like, yeah, so I'm going to have to change my bid now. So instead of $25,000 to build your deck, it's going to be $50,000. And you're like, holy crap, 50 grand for a deck? And then the contractor says to you, well, there's a supply issue right now because of COVID, so prices have doubled. And then you're like, well, should I just build it next year? And the contractor says, well, yeah, probably prices will be back to normal next year. And you're like, okay, well, let's just defer to next year. We'll build it next year. And the contractor's like, okay, cool. And you're done with it, right? So next year, supply meets demand, prices come down, and next year you call up your contractor, or you just Google, you go to Home Depot, and they're like, yeah, wood is cheap again. You're like, oh, good. Call up your contractor, let's build a deck. Contractor's like, great, I'll put you on the schedule. Done. That's if you just leave it alone. Okay? That's not stagflation. That's high prices. And because of that, what is the study of economics? The study of economics is choice. Your decision-making process. Prices are high this year, so you don't build this year, or you do something else. Okay? I was in this situation. Wood did double in price, so you know what I did? I'm not going to delay a year. What the hell? I need a new deck. So I buy TimberTech instead of wood. TimberTech is usually 3 times more expensive. Now it was only actually it was the same price. So I'm like, well, if I'm going to build an expensive deck, I'm going to build a TimberTech deck. Boom, done. Awesome. Now I never have to stain my deck ever again or pay someone, right? Cool. So I made a choice. Someone else could say, well, I can't afford the extra money, so I'll do it next year. That's how equilibriums work. So then eventually demand falls, supply goes up, you find a new equilibrium. Then because prices fall, demand increases, and you get to the normal equilibrium. Okay? So what is stagflation? Prices stay high forever, and because of that, nobody ever builds a deck. Okay? Do you see that should be impossible? I want you to think about that. Okay? That should be impossible. Let's make a graph. Okay? Demand. 1. Supply, 1. Okay? Okay? This is dollars. This is quantity. Okay? So 1, 2, 3, 4, 5 units of dollars. 1, 2, 3, 4, 5 units of quantity. Okay, so supply falls from 3 units available to 2 units available. Okay, this is supply 2. We shifted this way. Okay, see the shift from 3 to 2? What happened to price? Okay, we went from this equilibrium, E1, to this new equilibrium, E2. Okay, so at this equilibrium, price was 3. At this equilibrium, price is almost 4.5. Okay, prices went up. Now, if you're a supplier and you see prices went from 3 to 4.5, do you want to produce more or do you want to produce less? You're the supplier now. You make wood boards used for decking. You already have the factory. You already have the mill. You already have the workers. Yeah, I like the Ritz. Is it the Ritz-Carlton or the Ritz? The Ritz in Mayfair is cool. Okay. No. You make boards. You make boards yesterday, that you make boards today, you make boards next week, next year. You bought a factory, Nuno, and the factory makes boards. Okay? Sometimes you get paid $2.75 a board. Okay? Prices were closer to 3.0 recently. And now somebody will pay you $4.50 per board, per linear foot, whatever. Do you want to produce more when you get paid 4.5? Or do you want to produce more when you get paid $2.75? This is supply side. You're like, holy crap. Get some more trees, hire some more lumberjacks, hire some more people to work in the mill. We're going to work 24 hours a day while we can get this 4.5 linear feet board. Boom. Yeah, the Ritz. I like that one, Barry. Barry, if you go half a block towards the Thames and then cut through a little alley, you get to, what's it called? The Fox cigar shop, JJ Fox. Cool. Now, I just found out, Barry, because I'm a member of the Harvard Club in New York City, that just around that corner now, so now you take another right and then you do a left. The Oxford Club, now, and it's great now that I'm an Oxford student, but I can now stay at the Oxford Club in London right there. And I bet you it's a lot cheaper than the Ritz. And the Ritz is nice, right? But there's something awesome about you can't come into this place no matter what. Not you specifically, but that there's a guard at the front door that says, no, you can't come in to everybody. And you're like, wait, I'm a member of the Harvard Club of New York. I graduated from Harvard. I have a degree from Harvard. And they're like, oh, really? All right, you can come in. I'm like, oh my God, I love that. I love it. And you should see this place. It's like a palace. And they literally have a palace out in the English countryside that I can go and stay. I can take my family and everything. And it's funny because it's cheap. Not cheap, but cheap relative to, let's say, the Ritz right around the corner. So Barry, you'll stay at the Ritz. I'll stay at the Oxford Club. And we can meet up halfway for cigars. How cool is that? I just can't do it right now because I have a green card. So the U.S. government won't let me do that. All right. So anyways, someday though, hey, Barry? All right. So let's go back to this. So prices are high now. You're going to supply more. Okay? And what is that going to do? I'm not even going to shift demand. I'm just going to say, you want to build a deck. You'd like to build a deck this year, but if you have to wait till next year, well, you just build it next year. It's not going to go away. Okay? So anyways, so what'll happen is producers will want to produce more. So let's say 6 months goes by and they're working 24 hours a day. Supply increases, goes back to normal levels or even greater levels. But what'll happen is even if they oversupply, let's do this. Let's go to supply 3. They go ape crazy. Okay? They go ape crazy now and they overshoot. Okay? Prices dropped here. Or the equilibrium now drops to E3. What does that do? It lowers prices, increases demand to 4, and we're game on again. We doubled demand from 2 to 4 because prices dropped. We suckered other people into the market that were thinking about maybe building a new deck. Okay? So you're actually kind of increasing demand. It's just too cheap. I mean, now I could drag and I can double shift, but I don't want to double shift because it makes the answer indeterminate. So what I'm going to say is what'll happen is it'll eat up excess inventory and we'll get right back to here. Okay? If you just leave it alone, it'll all work out just tickety-boo and we'll be back here on the long run. The long run equilibrium will be our stabilization. Okay? Because if we run out of supply, suppliers will be incentivized to work harder and get more because we need it. If demand falls, then suppliers, what will they do? Put everything on sale, lower the price, increase demand. The excess inventory is gobbled up, and then they move prices right back, and supply and demand is in equilibrium again. So it will always, are you listening to me? This will always work. It's human nature. Always work. You will never, ever, 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 you will never, our economy will never produce stagflation. Never. Okay? Has the United States ever had stagflation? Let's see, some of you old guys, or maybe some of you historians. Why is it the media talking about stagflation? Well, first of all, it's sensational. The second thing is they just don't understand. So they're going to compare today with something else. What are they comparing it to? Has the United States ever had stagflation? And if so, when? Nixon? I think it was more Carter. Peter Schiff is more of, I think, a debasing of the reserve currency and all that kind of stuff. Yeah, Jimmy Carter, Nixon's too early. That was inflation, but later on stagflation. Okay? Do you have all the things you're saying in your book? No, we don't call it. This is economics, right? Okay, so great, Carter. So how the heck did Jimmy Carter create stagflation? How did he take high inflation that he inherited from Nixon's incompetency, okay, into economic ruin? How could you possibly create a distorted bastardization of an economy? It wasn't OPEC, because that just creates inflation. Okay? And of course, we know we already broke that by jacking up interest rates, and everybody loves Ronald Reagan but really it was Paul Volcker. Okay? Well, from the era, yeah, but that's inflation. But then it got to Jimmy Carter, and Jimmy Carter created stagflation. So how do you create stagflation if the United States actually had stagflation? This is why I'm bringing this up. So you'll listen to the media and you say, okay, I get it. Higher prices might slow growth, but that's not stagflation. How do you create it? By the way, if you're type in a question mark if you don't know and you just want me to tell you, I'm going to make you smarter than 99%. Raised interest rates? No. Well, that's how you kill inflation. The Fed's not worried about inflation. They're like, we have tools for that. Okay? Paul Volcker broke inflation through raising interest rates. Okay, this is good. So how the hell did Carter? Yeah, Nixon set it up for sure. But how the hell did Carter create an impossible, right? An impossible situation. How did he create it? Price controls. The government came in and said, oh, prices are high. So, right, prices are high. So we will say, okay, we are going to tell the world, okay, because prices used to be 3 and now they're 4.5. That's unfair to the good American people. So, suppliers, you are greedy. Suppliers, you are bad. Suppliers, you are taking advantage of the people by gouging them. So we are going to lock this in. You cannot charge more than $3. And they're like, but there's a shortage here. We can't get the wood. We can't get the labor. We can't get the loans. We can't inflation. And and the government says, no. You cannot charge a market rate because we're going to protect the people and you are bad. And so what happens is the lumber mill goes out of business. Lays off all its staff, sells its equipment for cheap, or can't afford to, reinvest, which is another way of saying all their assets depreciate and all that kind of stuff. There you go, Meta. Socialism does that with good intention. So Jimmy Carter came in and said, you can't charge a higher price. The government, not equilibrium, not the market. The government is going to take care of the people by dictating the prices that can be charged for things like lumber, dictating the prices of what you can charge for rent. And guess what happened? Stagflation. That's it. Because what happens is you no longer defer, you defer your deck. You're like, well, I can't pay 100% more. I can't pay $50,000 for my deck this year, right? Because there's no lumber. But then next year there's still no lumber and lumber prices haven't come down. So suddenly you never build a deck. And in 7 years, your deck falls apart and your house falls apart because now you can't afford the depreciation in your house. So you don't put in new windows, you don't put in a new roof, you don't fix your deck, you can't afford to fix your car has 380,000 miles on it, it's falling apart, but you can't afford to fix it, and there's no parts. And all the mechanics have gone out of business, so now every other people have lost their job because nobody has money to do anything, and it was all because the government came in to protect everybody. And we go all the way back to 100% of the people are poor, but everybody's equal. So it's fair. Bullshit. Doesn't work. That's how you get stagflation, by the way. You want a housing shortage? Put rent controls in a city. It's been studied 100 million times. The government says you can't charge more than $100 a square foot for a house in San Francisco. 8 years later, nobody can get an apartment in San Francisco. Why? There was no economic reason or financial benefit to a real estate developer to develop new apartments because they can never cover their cost. Why? Because the government's holding prices down. So, a real estate developer is like, let me think about this. If I put $50 million into a project, it'll take me 190 years to make my money back because rents are not at a normal market level. They're artificially low. Well, dude, I can't make any reasonable return on investment, so I'm not going to develop there. And they go develop somewhere else. Okay? William says, yeah, then you get the recession of 1980. Actually, that was necessary, and that's Paul Volcker. He came in, got rid of price controls, and then he jacked up interest rates so that mortgages were 20%, and he killed inflation, and he got rid of the stag. Okay, he got rid of the stagnation first. All you have to do is remove the controls. The second thing he did was jack up interest rates and killed inflation. Crushed the economy, created a recession, but by very early in the 1980s, then dropped interest rates, increased liquidity, and we had a 20-year bull run. And everybody thanks Reagan, Ronald Reagan, and I'm like, Reagan didn't do crap. Well, I shouldn't say that, but it wasn't Ronald Reagan, y'all. Okay, it was Paul Volcker. Think about this. I'm telling you, this is my serious opinion, and I think it's the truth. If Paul Volcker wasn't the head of the Federal Reserve Bank of the United States of America when Ronald Reagan was president, then people would not remember Ronald Reagan as a good president. Republicans worship Ronald Reagan. But at the time, they didn't like him. It's funny. But now through history and the romanticism of the big 20-year bull run, people go back and say, oh, that was Ronald Reagan. Okay? Well, he might have broke the back of the Soviet Union, but I think Paul Volcker, right, made America great again. What was Ronald Reagan's Morning in America? Have you guys seen Ronald Reagan's Morning in America? I wrote a paper on this, probably on YouTube. Ronald Reagan Morning in America, 1984. Very famous. I wrote a paper on this. Okay? Oh, look at this free ad for this group. Look, you can get rich if you buy this. Not.
It's morning again in America. Today, more men and women will go to work than ever before in our country's history. With interest rates at about half the record highs of 1980.
That wasn't Reagan.
New homes, more than at any time in the past 4 years.
See how good everybody feels?
This afternoon, 6,500 young men and women will be married. And with inflation at less than half of what it was just 4 years ago, they can look forward with confidence to the future.
Okay, interest rates have fallen, inflation has fallen, men are marrying women and women are marrying men. Republicans.
It's morning again in America. And under the leadership of President Reagan, our country is prouder and stronger and better. Why would we ever want to return to where we were?
Where were we? Jimmy Carter, price controls, stagflation. Now, I would argue low inflation, a booming economy, right? Low interest rates, so now you can actually get a mortgage. That's all Paul Volcker. And by the way, what is this? This is an ad to get you to re-elect Ronald Reagan. That's not the White House, my friend. What's he saying here? Anyways.
Of President Reagan, our country is prouder and stronger and better. Why would we ever want to return to where we were? Why? And
right? I think it's funny now where what the hell, dude? What am I getting? Skype bombed? Skype sucks. Just doesn't work. How many times do I have to turn it off? Anyways, let's move on.
And better. Why would we ever want to return to where we were less than 4 short years ago?
Okay. So anyways, so we look at this. Ronald Reagan made America great. I'm like, well, I think a lot of that is Paul Volcker, in my opinion. So, anyways, right? Anyways. So that's how you get stagflation. The government steps in and disrupts capitalism. So now when you're listening to the media or listening to an expert being interviewed by the media, or you're reading an article and they say, oh, this is a problem, the situation we're in now is going to lead to stagflation, they actually don't understand the economics behind what they're saying. They think they do, but they don't. And now you can step in and, right, and correct them. Wouldn't it be great, like you're watching CNBC and they have a big hedge fund manager or the head of some big bank talking about stagflation, and you're sitting there with your super big gulp and a bag of potato chips in the audience. You're like, and you raise your hand. Well, actually, you can't have stagflation. I understand what you're saying. High prices. And that's going to kill the economy, and that's going to raise unemployment. But what you're not understanding is people are just going to defer or make choices based on the high prices, both on the supply side and the demand side. And within a year or so, over a period of time, we will get back to equilibrium. Supply will catch up with demand. Demand and supply will be at equilibrium. Prices will be normalized and will be at a normal level of growth, depending on our savings rate and our investment rate that shifts our steady state along the curve at roughly 2.2% per year. So what you're actually saying, sir or madam, doesn't actually make sense. The only way you can get the stagflation you're talking about is if the government steps in to disrupt the natural process of supply and demand. And then the whole studio would go quiet. And the interviewer and the interviewee will just sit there like, oh, yeah. Yeah, that's a good point. You're like, just sucking on your super big gulp eating potato chips. Yeah, that's what I thought. But that's why they don't have a live studio audience, right? Okay, cool. Okay. Isn't that cool? So I didn't plan on giving you that lecture today. Yeah, all of that while eating potato chips, right? So anyways, you can see how very quickly things can fall apart. Okay? Just take that into consideration when the government starts stepping in to control supply and price. It's always going to run into a problem. Okay? It's always going to run into a problem. Okay? Okay. So if you want to learn more, do a Google search or something and find some information on rent controls. Okay? And you'll find out why rent controls are the government's design to make housing affordable. It makes sense. You'd like people to be able to afford rent. I get it. And then find out what the net result is over the course of time, and you'll discover that nobody will have a place to live. And that's not what the government intended. They wanted affordable housing. What they get is no housing. Okay? And of course, that's not what they intended. No one will have a place to live. Not even the rich, not the poor. Nobody will have a decent place to live. All right. My oh my, WTI, zippity-doo-dah, zippity-a. Let's do some price action. You ready? Up, 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 down, down, buy. 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 Up, 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 up. Okay? Started here, then here, then here, then here, then here. And now your question is, in the future, will you buy it here and will you buy it here? I don't know. Okay. Joseph says rents are high now. Yeah, because people can't afford a house. So is it the landlord's fault? Is it the builder and developer of the apartment building? Is it their fault? Okay. So remember, socialists always blame industry. Rents are bad. That was a big tenet of, which is funny. I didn't mean that, but that's actually pretty funny. Of Karl Marx's position. If you read, what was it? Das Kapital. That was Hitler, wasn't it? What was his? Anyways, if you read Karl Marx's stuff, he was very much against the idea of rent. Yeah, it was pretty funny, actually. Hey, Willie. Okay. But in other side is, because socialism, which is society, so they take the side of labor, which is fine. But then they'll say, well, the owners of the factory are bad. The owners of the stores are bad. Okay? The owners of the apartment buildings are bad. The owners are bad. Okay? And so, I don't know. So anyways, it's just, I'll leave it. I need to leave it. Let's move on. Okay. Decisions. Okay. What is it that you're trying to do here? Remember, I taught you this yesterday. Okay. When you have a high, set it up. So if you had taken my advice yesterday, you're on a trade today. You're welcome. The question is, if you're not on the trade today, what is it you're doing and why do you ignore my advice? Okay? Anyways, cool. We'll leave it at that. Okay? So, what am I saying now? Let's say it in English. If you are a buyer of this market, well, you're about 8 hours late, of course. So should you buy it now? One of the things I talked in my live group yesterday is that what you're supposed to be doing now is planning tomorrow. So what does that mean? Well, then you've already taken this trade because you planned it when we were here. Or you took this trade because you planned it when we were here. Okay? Or you took this trade because you planned it when we were here. Just send it to me, Daniel. Thank you. Okay? So what is this? Tomorrow's trade. Does it have to be tomorrow? Do you have to wait till Monday? Do you have to wait till Sunday? Can you do it today? Yeah, you could do it today. These are now your execution decisions. Okay? You can do this, or you can do this. Which one? I don't know. How would I know that? That's your decision-making process. Okay? There's only two decisions you need to make as a trader once you have a fundamental bias. What price do you want? And at what time are you willing to take it? Timing, okay, and price are determined by technical analysis. Time could be like the pattern. Is it price action on a 5-minute chart? Is it a 5-8 cross on a 15-minute chart? Is it an oscillator like a RSI or a stochastics? All of these are like time decisions. Okay? And what do I mean by that? Well, a big thing that I make a big stink about is the patterns are irrelevant most of the time. This is why, like, the easy sales pitch, if I was going to try to make money on you to sell you a bunch of education, I would say, oh, look, when you get this pattern, you'll always make money. Or when you get this crossover, you'll always make money. Bum, ba, bum, ba, bum, ba, bum. That's not true. Now, I can give you 100 examples of each of how it is true, but it's not true. So what adds more truth to this? That A, there's a reason, and 2, you're at support or resistance. There's a reason why it reversed up. There's a reason why it rolled over. And if you don't understand that concept inside your analysis, then the pattern itself is irrelevant. And what you'll find is at best, you'll get inconsistent results. Okay? And you've probably have seen that already. So what you have to do is decide, are you going to buy a dip? If so, how can you use, on let's say a smaller time frame now, a candlestick pattern or a moving average crossover or an oscillator shift in the context of buying the dip? And you'll see your results skyrocket. Yeah, that's right, Gary. Okay. William says, yeah, I think it depends on the country and culture. No, In many places, tenants and laborers were actually exploited. Yes, I agree with that. So that's too much one way. That's why you don't want all pure capitalism, because what happens is, look, some people just never make a lot of money. They don't create a lot of value. They don't, which is fine. Okay? But if it's too far that like Jeff Bezos owns everything, then that's not fair either, right? Like that doesn't work. So what I was saying where I was comparing Europe versus the United States is you have to decide where your wrecking ball is. How close to neutral or to extreme do you want to put your country, your economy? So Europe is closer to neutral. It's capitalist, but it's a lot more socialist. And a consequence of that is 7% unemployment all the time. So therefore, you're going to have high taxes. Okay? But you'll have a steady economy that grows less than 2%. And another one that is a little bit lower taxes, little bit more freedom to business, a little bit more freedom to the capitalist supply and demand model. The consequence of that is a little bit lower unemployment, but also a little bit higher income disparity. But you know what? In capitalism, if you're really smart, if you're a really hard worker, if you're very lucky, if you put yourself in the right situations, then you will be heavily rewarded. Now, you need to create a social infrastructure, not an economic infrastructure, but a social infrastructure that says everybody in our society has equal access, has fair access to be the person that stands up. So if you have a social infrastructure that says, oh, you can stand up and be the person that creates a new company or goes to a good university to get smart so you can create this innovation. If you have a society that says, okay, these people can, but these people are not allowed to. Okay? If your economy says blue-eyed people, green-eyed people can go to a good university and get a good degree, become very smart, and then, right? And then live their life. But brown-eyed people are not allowed to go to a good university. But after that process, everybody has free access to be a genius and start a new company, be very innovative, or work for a very innovative company because they're so bright and so educated, and then go on and now they're more likely to make millions of dollars, right? So what you have to do is have a government that says, look, if you want to step up in high school and be valedictorian, regardless of the color of your eyes, then you should be able to go to a good university, get a good education, and be as innovative as possible. And if you need to, access to capital, if you need access to whatever, it's available to you regardless of the color of your eyes. Do you understand that? Like, entrepreneurialism needs that. You need the smartest people ever, regardless of anything. You always need the smartest, the most provocative, most hardworking people from all walks of life, from all angles. Entrepreneurialism, well above capitalism, entrepreneurialism needs that. So now a government needs to step in and says, we not only do we support entrepreneurs, our economy creates entrepreneurs. Okay? That's why they should come into the 5th grade and say, how many people here want to make more money than their teacher? But then you'd need better teachers. Well, whatever. I don't need to go there. All right. I know several teachers that work really, really hard. And yeah, I'm not here to pick on teachers. Okay. 90% of the time, it's not the teachers. 90% of the time, it's not the students. 90% of the time, it's the parents. Okay? Okay. Anyways. Yeah, Darko, all that tells me, like, first of all, good job on your trading. Darko says his account's up 50% with low volatility and low drawdown, less than 10%. Okay. All right. So what you're doing is you're kind of doing something like you have 50% return over 10% drawdown. So we can kind of pretend this is a Sharpe ratio, right? So, okay, your Sharpe ratio is 5.0. Okay, would a professional investor invest money into someone that can produce a Sharpe of 5.0? What do you guys think? Everybody take a vote. Plus 50% return over a negative 10% drawdown. What does this mean? Invest or not invest? Well, Daniel's saying yes, but that's not really an answer. There's something that I'm asking you to interpret this situation from an investor's point of view. What does that actually tell me as an investor? Okay. William says, too risky. No, that's, well, a Sharpe ratio at 5.0. Okay. A 5% Sharpe means for every 1 unit of risk, you are provided with 5 units of reward. Okay, you are being compensated for your risk. It's not too risky. That's not what that says. Johnny's nailed it. A Sharpe ratio of 5 says leverage. Okay, that's what that says. A Sharpe ratio is a risk-adjusted performance. And the only way you can beat the market that much, right, is leverage. And it'll go instantly. People are like, oh my God, over leveraged. Okay. And so I congratulate you on your good returns. But what this will also tell you is, why do people use leverage? Because they got no money. Now, I'm being facetious here just to be funny, but also so that people remember it. So someone with money will say, all right, you got incredible returns, but no money. And therefore, leverage is a form of risk, but not the way that someone else said it. Okay. And that when you go through a period of drawdown, you'll also have negative 5.0 and whatever. So it's not wanted. Here's another way of looking at it. If I'll make up a number here, if you have a Sharp of 1.77, okay, money will rain out of the sky. Money will rain out of the sky. Sharp ratio of 1.77, people will go, holy shiola, really? Oh my God, over what period? In what market? With what correlations? Like, over how many trades? Is it one trade a year that you make? Or did you make 1,000 trades? Like, let's look at this. What the heck is this trader doing to get a consistent long-term Sharp ratio of 1.77? Like, oh my God, I want in on this. Then you find, well, the guy makes one trade a year. Oh, well, that's probably luck. And the next trade is -3 Sharp ratio. And you're like, okay, I don't want that. No, over 10 years and 10 million trades, there's a Sharp ratio of 1.77. See, what this tells you is trader one, okay? Trader one made $27,000. Trader two made $270,000. And trader three made $27 million. Who's the better trader? Okay. Well, so that doesn't tell you anything. Okay. All right. So then you start breaking things down and you say, well, let's look at the Sharp ratio. So let's take your return minus a risk-free rate of return over the variance of the portfolio. Okay. And you do some calculations and you then say 1.77, 0.89, and 1.0. Okay? This firm is producing the right amount of return for the risk it takes. Essentially, it's neutral. You're like, yeah, well, for what it's doing, that's about right. Is it exciting? You're like, well, I could look at other things, but I'm being fairly compensated. This is all right. This one, you're like, well, it's doing okay. It could do better, but it's doing okay. And then you're like, oh my God, this one is producing fantastic. Do you invest into this one? Well, be careful. What is this guy doing that made $27 million? Okay, this is scale. Now, what does this firm do? Well, they invest into the futures market. Okay, is the futures market liquid? Yes. And if you gave them more money, could they produce $127 million a year doing what they're doing? Yeah, probably, because they principally trade very, very liquid futures contracts in oil, gold, S&P 500, the 10-year T-note. It's very, very deep, very, very liquid. Shouldn't be a problem. So you're like, okay, this one might make money doing something else that works on an account that obviously has less than 100,000 in it, but would never work with 100 million. Because now the lot size would have to be so great that you yourself are moving the market, or you're doing something that's less liquid, or if this is like scalping, what'll happen is, because now your trades are so big, going from a $100,000 account to a $100 million account, you affect the spread, you're impacted by slippage. And when someone gives you some real money, your Sharpe ratio drops to 0.23 because now your costs of slippage and such are so high that it's not that attractive. And so the best fund here might be this one. Okay? But it might be this one as well. 0.89 it could be better. This is okay. This one looks fantastic, but you can't scale it. Okay? Gregor said he could be using a very good EA robot. Yeah, but you may not be able to scale it. So, for example, maybe this type of thing, you'd have to be a market maker almost to make money on that. Steven says, but smaller accounts are inherently more risky. Well, they're not inherently more risky. But if you want to scale up, what people say is they don't have the time because they don't have the money. I deal with this in my book where I say, I get it. In the beginning, you don't have any money and you're going to need money, but you have to reduce the risk over time. Okay? And after 3 years, you should have cut your risk at least in half. And that's your lot size relative to your account size. Okay? So for example, in 3 years, let's say you double your account. And you started off with 1 mini. Or well, 1 mini. Okay? When you double your account, you should still be on 1 mini. Or maybe you're doing 1.5 minis. Or maybe that's difficult but let's say it's this way. Let's say you start trading one standard lot. After 3 years, you double your account. Now you're doing 15 mini lots. You understand that? You've doubled your account, but your lot size has only increased 50%. Then you double your account again, and now maybe you're doing 2 lots instead of 3 lots. And you've reduced your risk again. Okay? Because at some point, you're going to have a Sharpe ratio that is a red flag. They're like, okay, we're really glad you're profitable. We're really glad your drawdowns are low. But for us, frankly, you're over leveraged. And we have a mandate here at our firm that says that we cannot be exposed to that kind of leverage. So thank you, but why don't you come back in 10 years when you have significantly more assets under management and a more realistic Sharpe ratio. And then they send you packing. Okay? So we'll get you there. Don't worry about it. Okay? Just out of curiosity, how many people like this type of subject matter? Versus just like, what's the next trade? Oh, no, Greg, that's right. No, you're not in a different world. The issue is leverage, right, Greg? So yeah, algorithms, like Greg, like I'm in an algorithmic trading program right now, right? So I get it. I'm not saying EAs aren't the way to do it. You're totally right. The issue that I'm bringing up is the overuse of leverage or the over reliance on leverage. And if you had $100 million, you'd never be leveraged 500 to 1. Okay? Right? At $50 million, you'd never be leveraged 500 to 1. At $10 million, you'd never be leveraged 500 to 1. With $10,000, maybe you're leveraged at 200 to 1. But I would argue that you don't actually need it. And that leverage, all you're trying to do is cheat time. I would say put in the time, because when you ask someone for real money and you're like, I doubled my account in the last 6 months, they're like, well, come back when you have 6 years of doubling every 6 months. You're like, well, they know you're not going to be able to do it either, right? So I don't think you can cheat time, and leverage is maybe just cheating yourself. So maybe in the beginning, you can grow your account a little more quickly, but I want you to reduce the rate of growth, but still have consistency in your trading style, your trade planning, your trading results, and lowering leverage. And I'm telling you, if someone is trying to analyze whether they should put a decent amount of money into your firm that's been trading for 3 years, and they see over a period of time you're steadily growing, lowering risk, you can explain that as part of your model. Right? Right? Joseph is too much info. Yeah, okay. Anyways. Well, so that's the other thing, like, right, an algo, Greg's like, he likes the use of algos, but likes to take the trades personally. And I'm neither here or nor there on that. They're just different beasts, right? So you can use algos to help you make decisions. And all firms that use algorithms use it that way. Some will also, all will use it for analysis. Some will use it for trading and analysis. Okay. So you could just this is a form of an algo that you might look at something like this and say, on this 5-minute chart, the only thing I'm allowed to do is buy. Okay. Cool. Hey, if you guys like what I'm talking about, join FX Bootcamp. Do it now. Do it this weekend. Start taking the training courses, get involved. Because over the next month, really over the next 3 weeks, you should probably watch every single video. Because as soon as we hit September, you need to be razor sharp. If we hit September and October, and you don't really know how to trade properly, you're going to miss the best part of the season. So if you're kind of like sloppy, lazy, mediocre in October, you're going to get destroyed. Not destroyed. You're just going to miss a huge opportunity because you're just monkeying around, half doing it, half-assed, being a half-assed trader. You're going to miss the best part of the season. So while things are quiet, you need to load up on knowledge is all I'm saying. So if you like my kind of point of view, get serious now. Join FX Bootcamp. Get serious now. Open an account at Trader's Way. But get serious now when things are quiet. Okay? Yesterday I taught people the one thing that will dictate what we're going to do the next 6 months. Very, very clearly, very, very specifically, with evidence to prove my point. And if you don't even know that, good luck. So anyways, have a great weekend. Peace on earth.